Are you ready to make your money work harder for you? Imagine taking $10,000 and watching it grow. But the big question is, where should you invest it? Today, we're diving into a thrilling showdown between two investment titans, VOO and QQQ. These two ETFs have the potential to skyrocket your savings, but which one is the real winner? In this video, we're breaking it all down. Whether you're a seasoned investor or just starting out, we'll guide you through the ins and outs of VOO and QQQ. You'll discover the key differences, the risks, and most importantly, the incredible returns you could see. And here's the kicker. One of these ETFs could potentially turn your $10,000 into over $1 million. Stay with us to find out which one and how you can achieve this even with just $150 a month. Let's embark on this exciting investment journey together. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Alright, let's get to know our contenders a bit better before we pit them against each other. We have two heavyweights in the ring, VOO and QQQ. Both are champions in their own right, but they play by different rules. First up, VOO, the Vanguard S&P 500 ETF. Imagine owning a slice of the 500 biggest companies in the US. That's what VOO offers. It's like a greatest hits album of American business, covering everything from tech giants to retail powerhouses. With an incredibly low expense ratio of just 0.03%, VOO is a cost-effective way to get broad market exposure. Plus, with over $1 trillion in assets, it's a titan in the ETF world. Now meet QQQ, the Invesco QQQ Trust. This isn't your average ETF. It's focused on the NASDAQ 100 index, which means it's all about the tech and innovation leaders. Think Apple, Amazon, Microsoft, the companies that are shaping the future. QQQ started its journey in 1999 and has grown to manage over $260 billion in assets. Its expense ratio is higher at 0.2%, but you're paying for a ticket to the cutting-edge growth arena. So, what makes these two ETFs tick? VOO's strategy is simple and effective. It passively tracks the S&P 500 index, keeping costs low and giving you a mirror of the US stock market. On the flip side, QQQ also uses a passive strategy, but it hones in on the NASDAQ 100. This focus means fewer stocks, but each one is a potential game changer in its field. VOO is your go-to for broad market stability, while QQQ is all about tech-driven growth. Each has its strengths, but how do they compare when we look at performance and returns? Buckle up, because the next part of our journey is where things get really interesting. Key differences. Alright, let's dive into the juicy part. What makes VOO and QQQ so different? These distinctions can significantly impact your investment journey and how comfortable you feel with potential risks and rewards. First up, let's talk about cost. VOO is like the budget-friendly superhero of ETFs with an expense ratio of just 0.03%. This means that for every $10,000 you invest, you're only shelling out $3 a year in fees. On the flip side, QQQ's expense ratio is 0.2%, which translates to $20 annually for the same investment amount. While both are cost-effective, VOO clearly wins the Thrift Award, making it a favorite for those looking to maximize every penny. Next, we need to chat about diversification. VOO gives you a slice of 500 of the largest U.S. companies, providing a broad market experience. This means your investment is spread across a wide array of industries, from tech to healthcare, consumer goods to energy. Think of it as having a diversified portfolio wrapped in one neat package. QQQ, however, is laser-focused on the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed on the NASDAQ. This means your investment is concentrated in tech and high-growth stocks. The top holdings in QQQ are tech titans like Apple, Microsoft, and Amazon. This tech-heavy concentration can lead to explosive growth, but it also means higher volatility. Let's zoom in on the top holdings. VOO's top 10 includes a mix of familiar powerhouses like Apple, Microsoft, and Amazon, along with value stocks like Berkshire Hathaway and Johnson & Johnson. This blend offers a balance between growth potential and stability. On the other hand, QQQ's top holdings are dominated by tech giants, with companies like Nvidia and Adobe joining the usual suspects. This tech-centric lineup can drive substantial growth, especially during market booms, but it also means riding the waves of tech sector ups and downs. Another crucial difference is how these ETFs handle stock weightings. In VOO, the top 8 stocks make up less than a third of the ETF, ensuring a more balanced approach. In contrast, QQQ's top 8 stocks make up almost half of the ETF, meaning a significant chunk of your investment is tied to these few companies. This concentration can amplify both gains and losses, depending on the market's performance. In summary, VOO offers broad market exposure with a low-cost structure, making it perfect for those seeking steady, long-term growth with less risk. Meanwhile, QQQ, with its focus on high-growth tech stocks, offers the potential for higher returns but with greater volatility. The choice between the two boils down to your investment goals, risk tolerance, and your confidence in the future of the tech sector. Now that we've highlighted the key differences, let's dive into the performance numbers to see how these two ETFs stack up in real-world scenarios. Buckle up, because the next part of our journey is where the magic happens. Top holdings. Now, let's dig into the heart of each ETF by exploring their top holdings. Understanding where your money goes can help you make a more informed decision. Starting with VOO, its top 10 holdings are a who's who of corporate America. We have Apple, Microsoft, Amazon, Alphabet, Google's parent company, and Meta, formerly Facebook, leading the charge. These tech giants are complemented by Berkshire Hathaway, Johnson & Johnson, and Procter & Gamble, adding a touch of stability and diversification to the mix. This blend of high-growth tech stocks and more stable, value-oriented companies gives VOO a balanced edge. It's like having a team of all-stars where some players are aiming for home runs while others are consistently getting on base. But what about QQQ? Here, the top holdings read like a tech enthusiast's dream portfolio. Apple and Microsoft still top the list, but the rest of the lineup leans heavily into the tech sector. You'll find Nvidia, Amazon, Tesla, Alphabet, Meta, and Adobe making significant appearances. This tech-heavy concentration means QQQ is heavily influenced by the performance of these innovation-driven companies. It's akin to putting your money on the cutting edge of technology and innovation, betting on the next big breakthroughs and trends. One interesting aspect is how these holdings are weighted. In VOO, the top 10 holdings account for about 27% of the entire ETF. This means your investment is broadly spread out, reducing the risk associated with any single company's performance. It's like spreading your bets across multiple horses in a race, increasing your chances of winning regardless of which horse finishes first. In contrast, QQQ's top 10 holdings make up nearly 50% of the ETF. This higher concentration means your investment is more heavily tied to the performance of these tech giants. While this can lead to impressive gains during tech booms, it also exposes you to higher risk if the tech sector hits a rough patch. It's like betting heavily on a few top horses in hopes they'll lead the pack, but knowing that if they stumble, your investment could take a significant hit. The different compositions of these ETFs reflect their distinct investment philosophies. VOO's balanced approach aims for steady growth with a diversified portfolio, appealing to investors who prefer a broader market exposure. On the other hand, QQQ's focus on high-growth tech stocks attracts those willing to embrace more risk for the potential of higher returns. In summary, the top holdings of VOO and QQQ highlight their unique strategies. VOO offers a balanced mix of growth and stability, while QQQ bets heavily on the tech sector's potential. Your choice between these two will depend on whether you're seeking broad market exposure or aiming to capitalize on the tech industry's dynamic growth. Next, we'll break down the performance metrics to see how these top holdings translate into real-world returns. Get ready to see the numbers that could shape your financial future. Performance and returns. Now, let's dive into the heart of the matter. How do VOO and QQQ stack up in terms of performance and returns? This is where the rubber meets the road, and the numbers will guide us to the best investment choice. Starting with VOO, this ETF has been a beacon of stability and growth. Over the past decade, VOO has consistently mirrored the robust performance of the S&P 500. Imagine this. If you had invested $10,000 in VOO 10 years ago, today you'd be looking at around $28,000, That's nearly tripling your money. VOO's diversified approach ensures it captures the market's overall upward momentum, providing steady, reliable growth. Think of it as a well-balanced cruise ship, navigating smoothly through both calm and stormy seas, steadily advancing your investment over time. But let's talk about the star performer, QQQ. This ETF has been nothing short of a rocket ship, especially in the last decade. A $10,000 investment in QQQ 10 years ago would now be worth an astonishing $53,000. This phenomenal growth is thanks to its heavy focus on the tech sector, which has seen explosive advancements. Investing in QQQ is like strapping into a high-speed rocket, aiming for the stars. When the tech sector is booming, QQQ delivers returns that are out of this world. But remember, rockets can be volatile, and the ride can get bumpy. Zooming in on the past year, VOO has shown a solid 17% return, reflecting the market's post-pandemic recovery and growth. This consistent performance is why many see VOO as a safe bet, providing steady returns without too much drama. QQQ, on the other hand, has outshone VOO with a dazzling 27% return over the past year. This surge is driven by the relentless innovation and growth in the tech sector. Companies like Apple, Microsoft, and Nvidia have seen their stocks skyrocket, pulling QQQ along with them. If you're chasing higher short-term gains and can handle the tech sector's ups and downs, QQQ is your ticket. Now let's talk dividends. VOO offers a dividend yield of about 1.3%. While it might not seem like much, these dividends are like a steady side income, boosting your returns through reinvestment and compounding over time. It's like having a reliable little bonus that quietly grows your wealth. QQQ, being tech-focused, offers a lower dividend yield of around 0.5%. The tech giants prefer reinvesting earnings into innovation and growth, so dividends take a back seat. If you're in it for the long haul and believe in the tech revolution, this trade-off can be worthwhile. Lastly, let's discuss risk. VOO, with its broad diversification, experiences lower volatility. It's designed to reflect the market's overall performance, resulting in fewer dramatic swings. It's the safer bet for those who prefer stability and consistent growth. QQQ, conversely, is more volatile. The tech sector can be a thrilling roller coaster, with rapid ascents and sudden drops. If you have a higher risk tolerance and are excited by the potential for substantial gains, QQQ could be your thrill ride. Just be prepared for the ride's wild twists and turns. In summary, VOO offers steady, reliable growth with a nice dividend kicker, making it an excellent choice for conservative investors. QQQ, on the other hand, promises higher returns driven by the dynamic tech sector, but with greater volatility and lower dividends. Your choice depends on your investment style and risk tolerance. Next, we'll uncover the strategies behind these ETFs to understand how they manage their portfolios and what that means for your investment. Stay tuned for insights that could steer your financial journey to success. Investor suitability. So, which ETF is your perfect match? The answer depends on your investment goals, risk tolerance, and personal preferences. Let's dive in and find out. If you're someone who values stability and consistency, VOO might be your best bet. VOO tracks the S&P 500, giving you exposure to 500 of the largest companies in the U.S. market. Think of it as a well-maintained, reliable car. No unexpected breakdowns, just smooth, steady rides. Its broad diversification reduces risk and provides a more predictable journey. Plus, with a rock-bottom expense ratio of 0.03%, more of your money stays invested and grows over time. It's perfect for conservative investors who cherish stability and gradual growth. On the flip side, if you're thrilled by the rapid advancements in technology and don't shy away from a bit of excitement, QQQ could be your ideal companion. This ETF focuses on the tech-heavy NASDAQ 100, giving you a piece of the most innovative and high-growth companies like Apple, Amazon, and Nvidia. Investing in QQQ is like riding a cutting-edge, high-speed train. It's fast and exhilarating, but the journey can be unpredictable. Although its expense ratio is higher at 0.2%, QQQ's potential for higher returns can justify the cost for growth-oriented investors. If you're comfortable with market swings and are looking for significant appreciation over time, QQQ offers a thrilling opportunity. Consider your investment horizon. If you're planning for long-term goals such as retirement and can ride out the market's ups and downs, both VOO and QQQ have proven track records. However, your choice might still hinge on your risk appetite. VOO is better suited for those seeking long-term, steady wealth accumulation with less drama. It's the dependable turtle in the race. Slow and steady wins. For those with a higher risk tolerance and a keen interest in tech, QQQ can be the hare, capable of explosive growth but with more pronounced highs and lows. If you're aiming to capitalize on the tech sector's potential and can handle the volatility, QQQ might deliver the returns you're dreaming of. Let's talk dividends. VOO's higher dividend yield is appealing if you're looking for some regular income from your investment. It's perfect for income-focused investors who want reliable payouts that can be reinvested to compound growth or used to supplement income, adding another layer of stability. Conversely, QQQ's lower dividend yield reflects its focus on reinvesting profits into further growth. If you prioritize capital gains over income and believe in the long-term trajectory of the tech sector, QQQ's growth potential might be more attractive despite the lower dividend payouts. Consider your overall portfolio. If you already have significant exposure to tech stocks, adding VOO can help diversify and balance your investments. Its broad market exposure complements a tech-heavy portfolio, reducing overall risk. On the other hand, if your portfolio lacks tech exposure and you're eager to tap into this dynamic sector, QQQ can fill that gap, providing a concentrated dose of high-growth potential. In summary, VOO is ideal for investors seeking steady, diversified growth with lower risk and a nice dividend yield. It's a reliable choice for long-term conservative investors. QQQ, with its focus on high-growth tech stocks, offers the potential for substantial returns but comes with higher volatility and lower dividends. It's suited for growth-oriented investors with a higher risk tolerance and a long-term horizon. Next, we'll explore the strategies and methodologies behind these ETFs to see how they manage to achieve their performance. Stay tuned to uncover the secrets of VOO and QQQ's success. Investment strategy. Now that we've explored the top holdings and performance of VOO and QQQ, let's dive into the heart of what makes these ETFs tick: their investment strategies. Understanding these strategies can provide deeper insights into their potential benefits and risks, helping you make a more informed decision. VOO's strategy. Broad market exposure. VOO, the Vanguard S&P 500 ETF, is all about capturing the essence of the American economy. It follows a passive investment strategy aimed at replicating the performance of the S&P 500 index by holding a portfolio that mirrors its 500 large-cap U.S. stocks. This approach provides broad market exposure, making VOO a go-to choice for investors seeking a diversified and stable investment. Here's why VOO's strategy stands out. Diversification. With holdings across a wide range of sectors, VOO spreads risk effectively, minimizing the impact of any single company's poor performance. Cost efficiency. Boasting an ultra-low expense ratio of just 0.03%, VOO ensures that more of your money is invested rather than eaten up by fees. Steady performance. By tracking the S&P 500, VOO aims to deliver consistent returns over the long term, appealing to conservative investors who value reliability. QQQ's strategy. Tech-heavy growth. On the flip side, QQQ, the Invesco QQQ Trust, is designed for those with a taste for innovation and growth. It tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies on the NASDAQ stock market. This passive strategy leans heavily into technology and growth-oriented sectors. Key features of QQQ's strategy include tech concentration. With about 60% of its holdings in tech giants, QQQ is positioned to ride the wave of technological advancements and industry disruptions. Growth orientation. QQQ's portfolio is packed with companies that are industry leaders and rapid growers, offering the potential for high returns. High liquidity. QQQ is one of the most traded ETFs, ensuring that you can buy and sell shares with ease, enhancing your flexibility. Comparing the strategies. Though both VOO and QQQ US passive strategies, their focus and execution couldn't be more different. Diversification versus concentration. VOO spreads its investments across 500 companies, mitigating risk, while QQQ's focused approach on 100 tech-heavy companies amplifies both potential gains and risks. Cost efficiency. VOO's rock-bottom expense ratio of 0.03% makes it more cost-effective over the long haul compared to QQQ's 0.20%. Growth potential. QQQ's emphasis on high-growth tech companies can lead to substantial returns, albeit with higher volatility compared to VOO's steady performance. Dividend income. VOO generally offers a higher dividend yield than QQ, making it more attractive for income-focused investors. Historical performance. When we look at historical performance, each ETF shines in its own way. VOO offers reliable, steady returns with lower volatility, making it a safe bet for long-term investors. QQQ has delivered impressive growth over the past decade, driven by the tech boom, though it experiences more significant value fluctuations. Risk factors. Each ETF comes with its own set of risks. VOO, while diversified, it's still vulnerable to overall market downturns, which can impact its performance. QQQ, more exposed to sector-specific risks, particularly in technology, meaning regulatory changes or industry disruptions can lead to higher volatility. In summary, VOO's strategy focuses on broad market exposure, low costs, and steady performance, ideal for conservative long-term investors. Meanwhile, QQQ targets high growth potential in the tech sector, appealing to those with a higher risk tolerance seeking significant returns. If you found this video helpful, make sure to give it a thumbs up and subscribe to our channel for more insights on investing and retirement planning. Also, leave a comment below with any questions or topics you'd like us to cover in future videos.